Step right up, the gates are wide. Mini-IPOs, it's time to ride. Investors come and take your chance. Regulation A, it's your finance dance. Open doors, let the capital flow. Transparency shines, now you know. From private to public, it's all in reach. Join the revolution, learn and teach.
Over the next 25 minutes, my goal is to show and demonstrate how investors have access to opportunities now through Regulation A, or what we call mini-IPO investment opportunities. Now, what's interesting is the mini-IPO gives everyday investors, non-accredited investors, an opportunity to identify and potentially invest in institutional quality deals that previously had been locked, that they were locked out of, or it had been gated for them. And so this is an interesting opportunity, interesting time in history where now everyday people are given this access. So my teaching method is fairly simple. What we plan to do is to educate, and we're going to illustrate, and then we're going to show you how to apply disciplined principles when making investment opportunities. Now, there are three general ways that issuers or owners of businesses raise capital. One is the Regulation D. It's a fairly quick way of raising capital. You have your traditional initial public offering, and then you have your Reg A. These three roads have different rules, different players, and different advantages. In the traditional IPO, we hear of the big companies going public. Everybody wants to be part of an issuer who's going public for the first time. The reason why, because if it's a good business model, then when that stock goes public, that stock is pretty much going to be, if it's a good stock, going to be at the lowest value that it will ever trade at. So oftentimes people want to be a part of it. And it's open to individual investors. However, most individual investors never get an opportunity to because they're locked out. That's where your big institutions play, or your high ultra net worth individuals have an opportunity to invest in these early stage investment opportunities. And then we have the Regulation D. Now, many of us are familiar with the Regulation D. It's a fast way of raising capital if you're an issuer, but think of it like a private dinner party. Now, if you're hosting a private dinner party, who are you going to invite? Well, you're going to invite your family, perhaps some friends or close associates, and they're not going to question much about what's on the menu because they trust you. It's a relationship based on trust. Well, the Regulation D is very similar to that. Regulation D is usually exclusive to family and friends or to accredited investors, and disclosure is not as important in those type offerings. But here's the question. What if there is a way that you could take a IPO type structure that's open to everyday investors, and then take a Regulation D that offers tremendous opportunity, that's institutional quality in a lot of cases, and bring those together? Well, that's what the mini IPO does. It allows us to bring the best of both worlds together. So what is a mini IPO or Regulation A investment? Well, Regulation A sits between a private placement and a full initial public offering. It expands access and increases transparency. And it does. Now, this doesn't necessarily mean that just because it's a Regulation A and it's a different type of public offering, that it eliminates risk. Now, in a Regulation A, who's in the room? Well, if you compare it to Regulation D, there are very few people in the room. You have your securities attorney, you have the issuer, but there's not a lot of compliance or oversight with the Regulation D. Whereas with a mini IPO, Regulation A, you have legal, you have your reporting, you have onboarding, and oftentimes you're required to produce audited financial statements as if it is a tier two Regulation A investment opportunity. And Regulation A was really designed to provide a level of transparency and protection for everyday retail investors because of the oversight and compliance through the Securities and Exchange Commission and through FINRA. So with the Regulation A, you have those specific guardrails that have been put in place that benefit those investors who are interested in investing in Regulation A's. Now, with regards to raising capital, you have the two spectrum or the two ends of the spectrum. You have your initial public offering through the traditional markets. On one end, highly complex, takes quite a bit of time. It's extremely scrutinized, heavy compliance. Then on the other end, you have Regulation D. In your Regulation D, not as much insight, it's much quicker in terms of raising capital. But the Regulation A sits right in the middle of those two. It provides the necessary disclosure and information and transparency that's required with the goal of providing information that makes that Regulation A investor feel more informed so that they can make better decisions with regards to their investment. So now, just because someone has been qualified by the Securities and Exchange Commission to issue securities under the Regulation A framework does not mean that the SEC has approved that investment. What it simply means is that that investment has met certain disclosure qualification standards. And disclosure is the key. As an investor, your ability to have a window or insight into the operations of that business organization that you've invested in, that provides, at least in the SEC's mind, a level of protection for you. Because now you can see what's going right, perhaps what's going wrong. Anything that's central to the performance of that company has to be disclosed in that Regulation A framework. But of course, as responsible investors, those who invest in any security, you want to make sure you take the time to take advantage of whatever disclosure that's been made available to you. Now, this is what I think is one of the most important slides that we have. This is our underwriting grid. Now, there's a difference between underwriting an investment opportunity and guessing. Right. When someone's guessing, perhaps they like the personality of the person who's presenting. Perhaps it sounds like a good idea. And so they're going to take their hard earned money that it took them a lifetime to accrue, and they're going to guess and say, well, hopefully this turns out. Well, and I don't think we have any investors like that in the room. But underwriting requires discipline and it requires a process. And there are 6 boxes that you want to check, and you're welcome to take a screenshot of this. This will help individuals to evaluate a deal. In fact, if you can answer these 6 areas, then you are an underwriter and not someone who's guessing at an investment opportunity. So when you're looking at an investment opportunity with regards to a Regulation A offering, uh, where do you start? Do you start with the beautiful marketing brochure that talks about all the great things that's going to happen? Or where do you start? Well, we provided this slide to help us, to give us an order in which we should examine or evaluate that investment opportunity. Now, for many of us, if we're investing in an opportunity, we probably want to know, how is our money going to be used? What are the use of proceeds? And more in particular, how is that money going to help promote or advance this business model or this business plan? Connect the dots. The money's going to be used to for this purpose, and it's going to produce this outcome. We want to clearly be able to see that. Then we also want to know what could go wrong. You know, many investment opportunities, when we're presented with it, it all sounds good, right? But time and circumstance can destroy any opportunity. So we want to understand, what are the risk factors and what could go wrong in a Regulation A investment opportunity. Uh, we are required, when we're requesting this to issue under the Regulation A, to disclose anything that could potentially or possibly go wrong in an investment. And so that information is properly disclosed. And then we want to understand the financials. As we examine and evaluate the financials, we want the financials to tell the story. This is how the money's going to be used. This is how it's going to create value. And this is who benefits. And this is how I get paid. So the financials tell the story. And then, of course, we want to understand who's managing this opportunity. What's their level of experience? Have they done this before? How much money do they have at risk? And so these are questions. And then we also want to understand how management is incentivized to promote and advance this business opportunity. And then, of course, as an investor, you want to understand how you get paid. You want to understand if there's a risk of your investment being diluted. And you also want to see clearly how you can realize significant gain. So we want to focus on signals and not noise. And, bold vision doesn't necessarily mean that you can't have an ecosystem. And sometimes there's an ecosystem that's designed to solve a specific problem. So as you examine and evaluate particular investments, the number one question that I always ask when I look at making an investment is, what problem does this solve, and how many people are out there trying to solve it, right? And if there is a clear problem that's being solved or addressed with regards, then that puts you on to something. That tells you that this potentially can be a great business opportunity, or it could be one that may not be so great. So we certainly want to make sure that we filter out the noise as we look at these opportunities. So there are three primary questions that we want to be able to answer, so that this will protect us from hype and marketing expertise. Uh, your investment opportunity should clearly answer these three questions. First of all, in order for us, or me as an investor, to realize the gains that have been presented to me, what are the things that have to go right? That's a reasonable question. But that's one you want to know the answer to. And you want those that are presenting the opportunity to you to clearly be able to articulate all the things that must go right in order to realize those gains. And then secondly, what could go wrong? Not only what could go wrong, but how bad can it get? Am I at risk potentially of losing everything? Well, that's a question we might want to know the answer to before we make an investment, right? And then finally, as we mentioned, how do I get paid? When do I get paid? What can I expect? Because at the end of the day, we're making an investment in an opportunity for the purpose of building wealth. And so that's a very important question that we want to ask and have answered. So the Regulation A certainly presents the best of both worlds. It provides opportunity to invest in institutional quality deals without necessarily being an accredited investor. You can be a retail investor and invest in these opportunities. So opportunities that were formerly only set aside for the ultra wealthy or those institutions through Regulation D opportunities are now open to everyday investors. So as you examine this, keep these things in mind. Access to investing is expanding. It creates a significant opportunity for everyday investors. And in order to win, it's very simple. You have to apply disciplined underwriting techniques. Some of the techniques we talked about, perhaps you made a copy of some of these slides, some of the questions that you want to ask. These are the things that not only make you an investor, but make you an investor who wins. And that's the key, and that's the goal. So that's our presentation, and I will take some questions if anyone has any before we conclude.
Thank you all for joining us today. Pioneer Realty, leading the way. With Charles Williams guiding us through. We appreciate the time you've given to. We value you. We're glad you're here. Together we'll navigate. Let's make it clear. Maximize your wealth. Embrace the new. Your future's bright and it starts with you.